Next up is our Climate Day CEO Spotlight with Larry Fink, Chairman and CEO of BlackRock, and David Rubenstein, co-founder of the Carlyle Group.
Larry, now that the election is over and it appears that Joe Biden will be the next president of the United States, what do you think that will mean for the climate change efforts? And what do you think it will mean for the Paris Accord? Will we now, because we're likely to rejoin the Paris Accord, give more life to the idea that climate change is an important problem we have to deal with?
Well, I would say, David, first, the private sector has been moving all along these last 4 years in the United States and the world in terms of getting more and more prepared for climate change. In fact, in 2020, we saw at BlackRock more than a doubling of investments towards climate change. And the inquiry we're having from US companies, US foundations, globally, we're seeing a change. So we were beginning to see this tsunami of change already from the private sector. And now with the potential of having a Biden administration, I think we're going to need the government to come along and help us on this journey. We are going to have to change the labor laws that were just fortified under the Trump administration related to fiduciary standard rule that makes it much more difficult to invest in sustainability for ERISA accounts. They're minor changes, but they could really assist many people to be investing in it. The thematics of becoming part of the Paris Accord is monumental also. I do believe it brings more global community together. It's going to be important now to have the whole global community come together. But I would just say over the last 4 years, we've been seeing a large transformation from private investors, both public and private, as they are now becoming more aware that climate risk is investment risk, and they're looking for more opportunities to participate in this giant change in terms of how are we going to be prepared.
Okay, the conventional wisdom maybe 50 years ago was that the CEO of a publicly traded company had an obligation to get the most profits legally that he could get or she could get. Today, the conventional wisdom seems to be if you're very good on ESG factors, that's going to be a good thing for your company. But is there any evidence that if you are really good at ESG factors, your company will actually perform better and your stock will be better?
Well, let me answer the question in a different framing. I believe stakeholder capitalism, which ESG is a part of, is a major component of how business leaders and their board are moving forward. And there's quite a bit of evidence of companies that are focusing on stakeholder capitalism, their employees, their clients, the communities where they're working. Their shareholders are going to be the biggest beneficiary. And we're starting to see that in quite a bit of evidence, even in you asked it, framing it with the ESG, even companies in hydrocarbon industries, those companies who are more and more focused on ESG strategies and stakeholder capitalism, they're trading at a higher PE than some of the companies that are in denial. And so we are seeing this reallocation of capital within industry, within companies in industry, that we're seeing capital moving towards more and more of these companies in terms of their performance, and it's being validated by their profits. But this is a long journey, David. I'm not here to suggest all companies that are totally focused on ESG or stakeholders are all going to be perfect. And we're going to have to see, are they keeping to their commitment over a long period of time? But in the last few years, as we have evolved, the purpose of a company, and as we are now raising questions, what is the true purpose of a company? You raise the purpose that is profitability for your shareholders. I think that is evolving and changing. That as that purpose is evolving and that focus towards your clients, your employees, and your community, especially in a deglobalized world, we are seeing more and more evidence that the best companies with those factors in each of the different of the industries, they're outperforming their peers, and I think that will continue.
So Larry, your company is the largest money manager in the world. And when you started the company, I think in the 1980s, probably ESG was not as big a factor as it has become. So as you are looking at other companies on their ESG factors, what should somebody look at you at and say what you are doing that is good for ESG in terms of the large company that you run?
Well, when I write my CEO letters, I have to ask myself, are we doing what I'm asking other companies to do? So I frame every letter with the idea we better be doing as much, if not more. And I think so. This past year, I asked more and more companies to report under SASB and TCFD. And we are reporting and are more and more transparent toward this. And our rankings within SASB are quite high. We're evolving and changing. And David, we're not perfect. We make mistakes, and we're evolving. We're trying to work on our diversity metrics at BlackRock. Our compensation metrics are strong across the board, but where we were weak in some of our issues, we were not placing some of our women in the highest paying jobs at BlackRock. And now we're trying to evolve that and moving them to the portfolio management team. So we're doing a lot more prescription in terms of navigating BlackRock to do what we're asking other firms to do. And I would say we've made a lot of progress for that. It would be irresponsible if BlackRock is asking other companies to do something and we're not doing it. So I would frame it that we are as focused on these issues as any company.
So after the election results seem to be evident to most people, the day or so after the recent presidential election, the stock market went up uh, quite nicely in the view of many people. Was that because the country wants divided government? You have a Democratic president, it seems, and it seemed at the time a Republican Senate, and it may well turn out to be a Republican Senate. Do you think that the market actually likes divided government, or the fact that the Democrats did not control the Senate and their kind of agenda for the of some people in the Democratic Party is not likely to be implemented? Is that why you think the markets went up?
I would say overall the market likes a divided government. They want to make sure there's proper checks and balances. We've seen in the past when we have a government that is totally controlled by one party, we have actually seen more extreme in terms of positions that they've made. Um, and so I think a divided government, but also I do believe strongly that the market is in desire of more stability, of less volatility. They're looking for a voice that moderates, not a voice that incites. I truly believe President-elect Biden can be that voice of reason. He can, and if we all listen to his speech last Saturday, where he's talking about one America, not a red or blue, and so I think the marketplace is encouraged by having a leader now that is more inclusive, a leader that could probably bring a little more global harmony. Um, and I think we're all tired. We're tired about all the volume we hear out of Washington. We're obviously very tired about COVID. I and we are worried about where we are going right now in these coming weeks. And so we're looking for a new leader to help us navigate COVID and moving forward. We're looking for a leader who has a stronger opinion on climate and is willing to work with the world on moving forward, both in climate and all other global issues that are facing our world today.
So let's suppose President-elect Biden is watching you right now, and he says, "This seems like a person who knows a lot about the markets, and he seems to be favorable to me. So maybe I'll call him up and ask his views." And if he calls you and he says, "Larry, tell me the two or three most important things I should do to deal with the economy and the markets, either in the transition period of time or in the early in my administration," what would you recommend that he do?
Well, I would recommend him not talk to me now and just get his staff, getting his administration in order, getting his cabinet in order. But if he still insisted in talking to me, I would say, and I've said this loudly, even in front of the Trump administration in 2016. If we want to create really good jobs in this world where we are focused on jobs, and we're seeing a huge transition in this in this COVID world and post-COVID world where jobs are going to be moving from one industry to another, I truly believe we as a country, more than any other country, we need a strong infrastructure bill right now. We have $2 trillion of deferred maintenance. One of the first things I would be telling the president, he should make a statement that every American will have broadband. What we've learned in our COVID world through the use of media and video conferencing, we're doing more and more work from home. We're doing more and more education from home. We're actually having more conversations with our medical support, our doctors from home. And for those homes that do not have broadband, we are creating a greater and greater economic divide. I mean, we're living in the worst recession in our lifetimes because of COVID. The impact on the recession is far greater in the low income workers. We're more reliant on home education, and so many components of our society are not part of that. And so I would urge our new president, but I would urge every government to make that pledge to all their citizens, having broadband in every home and equalizing technology. If technology is, we're already witnessing is a great divide in the world between developing countries and developed countries, but technology is becoming the greatest divide too between different parts of our society. And we need the infrastructure. We need to be developing, broadband as we roll out 5G. But 5G is not going to be rolled out to every part of the country. It's not going to be rolled out, and we have to have something with a public support if we're going to roll that out throughout the country, and that everybody, from somebody in a city, from somebody in a very rural area, has that access, so they could have the ability to have an equalized opportunity.
Larry, the markets are assuming, I believe, that a stimulus bill of at least $1 trillion will pass in the lame duck, and that maybe another stimulus bill will happen early in the administration. If there were to be no stimulus bills of size, do you think the markets would take a very bad reaction to that?
Uh, I would take a very bad reaction. Whether the markets would, we would, let's see, but probably. I think we as an economy and most developed economies are over reliant on monetary policy. And we are heavily, and because of monetary policy, we've seen great support to the capital markets, and we've all been benefiting from that. If we want to create a more equalized economy, we have to do targeted fiscal stimulus. If we're going to just rely on monetary policy, that is another example that's creating more and more income inequality, because those who own equities, those who own financial assets are generally wealthy people. The poor do not own financial assets. And so we have the divide because of the strength of the equity markets and the job losses that we've witnessed has really created even more of an income inequality. Now, I'm fully supportive of monetary policy, so let's be clear. I believe what Jay Powell and the Federal Reserve has done has been nothing but amazing. But if we are going to try to really rebuild our economy, we truly need a very targeted fiscal stimulus for those who are still unemployed. We need to do a fiscal stimulus for some of the cities that are most impacted. And I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy. And that's going to be essential for the Biden administration.
If we do have a stimulus bill that's significant, that's going to increase the debt. It's already $27 trillion, and the annual deficit is about $3.2 trillion. So, in terms of money we're borrowing right now. So, how can we afford this? And why are the markets not worried about this enormous amount of debt and annual deficit?
Well, I would say we should worry about it, but it's not a major issue today. We're not witnessing inflation. If anything, you could see from the private equity side, we see that from the full alternatives and liquid markets, that there's actually a shortage of high quality investments right now. And so I would say the markets are correct in not worrying about the deficits today. What we do need is, through stimulus, we need to get growth going. And as we get growth, then this deficits that it'll ultimately be probably north of $30 trillion. These deficits are going to have less impact if we have a broader, larger economy. If we can't find a way to create growth in the coming 5 years, then we are going to face the impact of this rising deficit. And at the same time, in the next 5 to 10 years, we are seeing an aging global population, especially from Japan and China. They're going to go from savers to spenders as their economies as their population becomes older and they're retiring, and they're going to be utilizing that savings for living in retirement. And so this is going to be a problem if we don't find growth.
Final question, the remaining few seconds we have. Suppose the president-elect sees this interview and says, this is a very smart man who's built the largest money manager in the world. I need him as Secretary of the Treasury, Chairman of the Federal Reserve, head of the World Bank, head of some other major part of the federal government. Your response would be what?
Thank you for that honor, but I'm very happy at BlackRock. I committed to my employees and to my board that, and to my family already, I'm staying in New York for the time being.